Don't blame low interest rates for the housing bubble. That is what Bernanke is saying in response to critics attacking the Fed's policy. Let's go now to Peter Cook in Washington with more. Peter?
Well, Scarlett, speaking to economists in Atlanta on Sunday, Bernanke pushed back against criticism the Fed kept interest rates too low for too long, and that fueled the housing bubble and the subsequent financial crisis. Bernanke said the central bank's decision to lower interest rates to 1% after the 2001 recession and the 9/11 attacks appears to have been reasonably appropriate given economic conditions. Now, Bernanke, of course, supported those rate cuts as a Fed governor starting in 2002. The chairman said exotic mortgages requiring little money down were more to blame, and better regulation should have been the policy response.
The best response to the housing bubble would have been regulatory rather than monetary. Stronger regulation and supervision aimed at problems with underwriting practices and lenders' risk management would have been a more effective and surgical approach for constraining the housing bubble than a general increase in interest rates.
Bernanke conceded the Fed's efforts to constrain the bubble were too late or were insufficient, but he touted the central bank's more recent efforts to bolster regulation and consumer protection. He also very carefully left the door open to using interest rates to address asset bubbles in the future, but only as a last resort. And of course, Scarlett, this is more than just an academic exercise for Bernanke. The speech is a direct attempt to address one of the biggest criticisms leveled at the chairman as the Senate considers his renomination later on this month.
All right. Thank you so much, Peter Cook in Washington, for us on Bernanke firing back.